Hello, and welcome to Credit Matters, the podcast where credit absolutely matters. I'm Shankar Ramakrishnan, your host and head of US credit and global market engagement at Informa Global Markets. I'm here with my colleague and co host, Bruce Clark.
Hey, buddy, good morning.
Good morning. Head of rates market coverage at IGM. Uh, Today, we will be talking about the influence of Asian investors in the dollar markets. Asian and more broadly, non US investors have been particularly active in the dollar markets, helping strengthen order books that were built overnight outside US hours. There is also a thriving Reg S market where dollar denominated bonds are sold to non US investors. We'll also be talking about how interest from this group of investors towards US dollar bonds has changed or not changed with central banks globally starting to tinker with their interest rate policies because of the Iran conflict. We'll also talk about more broadly debt issuance from companies in emerging markets and whether there is a move to diversify away from dollar markets. We'll be asking answers to these critical questions to Jonathan Anderson. Welcome, Jonathan. Hi.
Thanks, Shanks. Good to be here.
Yeah. He's the global head of debt syndicate and head of DCM at SMBC Nikko Securities America. So, Jonathan has nearly 20 years of experience advising clients in all areas of fixed income in the US and international markets. Prior to joining SMBC in 2018, he spent 10 years at Goldman Sachs, working from the bank's London and New York offices. Jonathan, I know you from the Goldman days. So welcome, sir. Welcome.
Thank you.
So let me kick it off. So how influential is this whole Asian and Middle Eastern investor demand for the US fixed income markets here?
It's been a very influential dynamic, and we've seen it represented in order books. We've seen it represented in reverse inquiry, and generally, I would say the prominence of participation from non-US investors, as you mentioned, particularly those in
Right.
the Middle East as well as Asia, has been a theme of growing importance over the last several months and really, I would say, over the last couple of years. Historically, that investor base has always represented an important part of any US dollar order book, but I think the influence has grown, as
Right.
has the focus from those regions around the US market.
What is triggering this? Like, why are they so interested in dollar bonds at this point? Is there a motivation behind it?
I think part of it is just the overall growth of the US dollar market. We've
Right.
seen increases year on year, broadly speaking, for the last several years. This year, of course, as you and the team know well, is expected to be another record year of total issuance in dollars. So I think in part that's a driver. Additionally, the historically attractive yields that the dollar IG market has been offering has been a sought after investment opportunity by those investors. And then finally, we've seen funds flowing into those regions, and the dollar market being one of the most liquid opportunities to deploy some of that liquidity has been a driver as well.
In terms of like, what is the proportion of this kind of investor demand in what we see in the dollar markets? Is there like a number to it or?
So as you can imagine, it varies deal by deal.
Right.
Historically speaking, it's interesting. We haven't actually seen, I would argue, a material shift on a consistent basis as to the overall percent that non-US investors represent in order books. And I think that's due in part to the overall growth that we're seeing in demand across investors globally. What I would note, however, is some of the participation vis-a-vis non-US investors is done based on allocated capital from these institutions to external money managers. So as an example, you might have a large investor in Japan that allocates a portion of their fixed income assets under management to a third party, and that incremental liquidity is invested vis-a-vis that third party, and in many instances that is a U.S. manager. So there's the component of it that you see directly from these
Right.
investors, but there's also external money that's managed, and that tends to be more, I would say, advertised in the form of direct conversations or anecdotal color from
Right.
some of these money managers. But overall, there's no question that we're seeing an increase across the board.
Seeing that we're witnessing a divergence in monetary policies from different regions around the world, how's that affecting how your clients view the dollar markets vis-a-vis other markets? The Fed is generally seen to be staying on hold here for the next, at least throughout the course of this year and possibly next year, whereas rate hike expectations are priced into Europe and Japan. And how's that sort of affect the investors' view of things?
So I would say, there's clearly mixed opinions right now as to the direction of rates in the U.S. as well as those in Europe and in Asia. Japan, Bank of Japan policy has changed from the historic approach within the last several months. That has stimulated, I think, more capital, not only flowing into Japan, but also a lot of domestic capital looking externally. And in many instances, that capital finds its way to investment grade transactions in the US. And so I think overall, though, what we're seeing is more of a globalization of the marketplace. So liquidity flowing from one region to another, and vice versa. So while you do from time to time get diverging views from investors as to the direction of interest rate policy, I think overall the asset class, regardless of whether it's in dollars, euros, or another currency, is still offering a very attractive return profile. And as a result, you aren't necessarily seeing the total level of activity meaningfully outperform in one market versus another. You do get instances of outperformance, perhaps on a month or a few weeks basis. But overall, what we're observing thematically is, I would argue, a rising tide lifting all boats, and that's been
Right.
true across the major currencies.
Gotcha. Did you ever since the Liberation Day tariff announcement back in more than a year ago, and again with the start of the Iran war, a theme running through the macro markets was one of disinvestment from U.S. assets, notably Treasury bonds and other assets. Have you seen any of that? I mean, you hear a lot about it, but the actual data, the data that I see, at least the Treasury data, doesn't support that at all. Do you see any of that, or has that been an issue?
It's a great question, and it was certainly a very topical theme, or at least very often talked about theme immediately following Liberation Day. Investors, I think, were strategizing around regionally, was there a more advantageous way to be positioned? Ultimately, when it comes to order books, secondary activity, and what investors ultimately invested in, we didn't see it play out. So the headline that was often referenced, this "Sell America" story, it didn't ultimately manifest in the book dynamics that we were seeing. Investment grade credit in dollars continued to be very popular, and it was popular across different global investors. So there wasn't in any way, at least what we observed vis-a-vis the deals we were involved with, a material shift. So it felt much more a headline that investors and issuers were talking about, but not one that ultimately played out in the data.
Yeah, that's my experience as well. It made a lot of noise, but it never, when the data came in, it wasn't there. So
hmm
So, Jonathan, can I also ask you about this Reg S dollar markets, right? Like the one which non-US, so the US investors don't buy these bonds, but that has also grown a lot as well, right? So it kind of plays into the similar kind of theme, you think? as we are
Yeah,
seeing in 144A and SEC registered?
it has grown, and often historically, many of the non-US issuers will look to the Reg S markets as another avenue for liquidity, which, depending on the borrower and depending on the circumstances around a particular deal, can offer a more efficient route to
Right.
secure liquidity vis-a-vis a deal. That those transactions, as I know you know well, tend to be smaller than the
Right.
SEC registered or the 144A market, but the path to liquidity in many instances can be faster. And we've seen growth in that market alongside the dollar market. And it is in part to the theme that we're speaking of
Right.
around a lot of these institutional investors having more liquidity. And so they're generally speaking more active across the different investing opportunities. And one of those, as you noted, is certainly the Reg S markets.
So how does a borrower choose between which market to tap? Like, what is the difference between, tapping a Reg S market and I guess you alluded to the size preference as well. You get more liquidity out of the 144A markets than the Reg S markets, I guess.
Some of it is definitely size driven.
Right.
So the Reg S market, as you know, tends to be smaller. And in many cases, I would say the average deal size is anywhere between 500 million to a billion. In rare
Right.
instances, you do have the opportunity to access more liquidity than that, but it usually is for borrowers whose financing needs, at least on that particular deal, are more modest. And so that is certainly one motivator. Another motivator for why a borrower might not elect to choose a Reg S only transaction is diversification of the investor base. So
Right.
if you have familiarity with more of a global buyer base, including those US based investors, the
Right.
opportunity to access liquidity on a go forward, and certainly that particular deal is larger. So I would say for the most part, the borrowers that we tend to see most frequently using the Reg S market have more modest financing needs, and in many instances have regional operations
Right.
more focused in the areas where those non-US investors are based. So a lot of APAC borrowers, a lot of EMEA-based borrowers, those are generally the most frequent users of that issuer opportunity.
Like Middle East, everyone talks about Middle Eastern investors. Are they like very, very active in the dollar bond markets, you think? And what kind of deals do they buy? Because they also have equity investments in these companies.
We're definitely seeing, I would say, healthy participation from that
Right.
investor base. Depending on the particular deal, certainly from issuers that are located in those regions. So Middle Eastern-based issuers, we tend to see strong support from the Middle East regional investors, but we're seeing it away from that. And it will depend on the particular sector or the rating profile of the borrower. But
Right.
again, similar to the themes we were discussing with Asian investor participation, that's also certainly been an observable dynamic across the Middle Eastern investor base as well.
Yes.
Sorry, Sanks, is there a geopolitical element to the Middle Eastern investor appetite? In
Right.
other words, a sort of a willingness to, especially with this war in Iran, a willingness to sort of more or less be on the side of the United States and to express that through, uh, buying paper, U.S. dollar-based paper. Is there an element of that, or am I off base?
I haven't seen that dynamic, or at least I haven't heard that dynamic being a particular driver. I think ultimately a motivator is dollars is the most liquid asset opportunity for these investors. Many of the inflows that they get are dollar based, and certainly from an issuance standpoint, the familiarity with a lot of the regional issuers is generally going to be higher. And we see that dynamic play out across other regions. For example, an Asian-based issuer might have a larger percent of the order book be Asian investors. So I think that's one of perhaps the more common themes that we see driving distribution of the order book. But to your question, I haven't seen that dynamic
Okay.
specifically play out, but certainly the support is there.
And Jonathan, I wanted to talk about, emerging market issuance as well. I know that you've been very closely, covering that market as well, and you're in charge of it now. it's like, how does that? I thought like oil prices rising, that could have an impact on some of these oil-dependent economies, but we are actually seeing a surge of issuance and surge of interest for their bonds. What's the dynamic there?
Issuance, as you said, within emerging markets more broadly is year to date. We're seeing significant levels. So last year was a record year for supply within emerging markets. We had a total of, I want to say, 560 billion
Wow.
approximately.
Right.
And year to date, we are running at an issuance rate of about 33% more active than where we were last year. So,
Right.
barring any unforeseen development, it looks as though there's a reasonable chance we'll see another record set this year across EM.
Right.
And that's including Latin America, it's including Asia, as well as the Middle East and Africa. I think a lot of the same themes that's driving that increased issuance and increased investor focus are also true of the investment grade, or rather the developed markets.
Right.
It's maturity driven, it's liquidity driven, it's inflow driven, and ultimately, I think what continues to be, on a historic basis, attractive investment yields for a lot of these investors. And so investors and portfolio managers across the board, I think, are looking to be strategically positioned in places where they feel they can generate alpha and outperform the various
Right.
indices.
Right.
And I think as we're speaking to Latin America, as we're speaking to the Middle East, there is consensus there will be opportunities to outperform perhaps other investment classes. And so it's difficult, I think, to
Right.
identify a unique theme perhaps that's driving it, but I think a lot of the same topics that we've been discussing are ultimately also contributing to the outperformance and activity in EM as well.
So the oil price rise, it doesn't seem to have an impact. Is it because the companies themselves are doing well despite that? Is that what is differentiating, investor behavior towards them? Yeah.
The results that we've seen in terms of quarterly earnings from a lot of these businesses, and of course it will depend sector to sector, but
Right.
they don't appear, at least as of this point, to have been as negatively impacted as was feared, certainly at the outbreak of the conflict in the Middle East. So far
Right.
the data supports, I think, the optimism around the growth profiles of a lot of these companies. Obviously, I think investors will be watching closely if that changes over the next quarter. But at least based on today's headlines and the drop in oil,
Right.
it feels like there's light at the end of the tunnel, so to speak. And
Right.
and clearly, at least from a futures perspective, the optimism is there in full force.
Yeah,
Right.
I mean, we've noticed that actually in the broader marketplace for at least a month, Jonathan. I mean, where you'd walk in and turn your screen on every day, and some
Right.
over-credentialed economists would tell you why emerging markets are screwed, and the world is people don't understand what this high oil price means longer term, and then 5 minutes later, small caps and emerging markets are making new highs on the day and on the year. And it just, it was a classic, back in my day, there was a term called climbing the wall of worry. And markets would, despite seemingly bad news, markets would just keep going up and up and up and up. And then in the emerging markets, to me, seem to fit that bill. And it's been quite remarkable, right, to see these regions that were supposedly vulnerable to energy shocks and various things just go flying ahead. I mean, same could be said with the earnings season that's underway now.
I think to your comment, the strength that we've seen in the developed as well as the emerging market has been very encouraging. And in many instances, perhaps the headlines that we're seeing now in a different type of market, you could have witnessed a dynamic whereby it was more of a defensive sentiment or more of a risk-off tone, at least in terms of trading activity. But we're not seeing that at all now. I think the enthusiasm and outlook, as well as how investors are positioning both in primary and secondary, speaks to a lot of, I think, opportunity
Right.
around seeing spreads move tighter, seeing liquidity continue to develop, and what appears at the moment, at least, to be minimal impact from the higher oil prices in an aggregate basis for a lot of these countries and sectors.
Is that complacency, you think, Jonathan? Or like because so based on your experience of watching these markets, do you think the markets are being too positive all the time rather than correcting for a little bit?
Well, I think when we have seen correction, it's been relatively short-lived,
Right.
and many of the investors have looked at any widening as an opportunity to add risk and add exposure at more attractive entry points. And I think part of that is driven by the level of liquidity that is represented across the capital markets. And ultimately, portfolio managers are paid to actively invest unless they're, of course, managing a passive fund.
Right.
And so when you do have these moves wider in the market, as a reaction to headlines or some of the geopolitical uncertainty, I think generally speaking, they've been rewarded by
Right.
proactively taking advantage of those circumstances. And the market over the past really couple of years, barring few, isolated incidents of volatility, if
Right.
you've been long, you've generally performed well. And I think that dynamic to proactively participate even during periods of widening, that
Right.
strategy has been rewarded more than it's been punished.
Both me and Bruce have talked about how even though however fickle the equity markets have been, like, they've been jumping up and down, but credit markets have been very steady and they have been like, there's a lot of demand coming in for bonds. They are seeing something which is more positive than everyone else. It almost seems like that.
Well, I guess other than, for example, oil, which has obviously seen up and down movement in the last several weeks, we're really seeing across the board this level of optimism and
Right.
call it forward-looking trajectory. Clearly on at least the U.S. equities, we're seeing record
Right.
all-time highs across the major indices. We're close to record tights in investment grade. And so I would say this positive bias towards risk, while in our world we most focus on it on fixed income credit, but we're seeing
Right.
it evidenced across other asset classes as well.
Right.
Yeah, I mean, look at just take the first quarter earnings season, for example. I mean, barely, 5 weeks ago, the year-on-year S&P 500 earnings estimate was about 13%, uh, growth rate of about 13%. Here we are, second week of May, and that's doubled now. I mean, the sort of the blended tracking of S&P 500 growth is like mid 20s now.
And
So it's accelerated as we're going through the season, which certainly helps explain why the markets are going higher.
no,
Uh,
it has, and to your point, I would say the revised outlook, or at least a number of the results that we've seen, many of them are from large, well-established names, and
Right.
so I think the enthusiasm, to your point, has only grown in the last several weeks, notwithstanding what it was already at being a very high level. So the backdrop right now feels exceptionally strong, and
all right.
Right.
we're clearly seeing a lot of borrowers take advantage of those liquidity opportunities.
We had a guest on several weeks ago who made the point that uh, 2 points actually. She said corporate bond investors were generally underweight high yield credit coming into the Iran war, so that sort of helped keep appetite flowing. And number two, she said that the Liberation Day blowout in the markets left a mark on a lot of people where the markets got cheap, but very briefly, and it created a huge opportunity, but like nobody could get anything done. So they're sort of determined, like, hey, the next time there's a headline and the market gets blown out, don't miss it, right? Get on it. So I think that there's some of that psychology at play.
Oh, without a doubt. I mean, I was I was out with an investor shortly after Liberation Day happened, and the portfolio manager mentioned it being a tremendous buy opportunity. And he said, look, with very few exceptions, anything you buy now in 6 months, it will have likely performed very well. And I think that dynamic of not wanting to miss another attractive entry point
Right.
has certainly been contributing to I would argue what feels often like a ceiling in terms of
Right.
how far spreads widen vis-a-vis some more defensive or negative headlines. We're just not seeing a sustained move wider represented in really any of the major markets that we're looking at.
So, Jonathan, I wanted to also ask you about what clients, the borrowing clients are asking you about, in terms of diversity of funding. Is there, because there is so much coming into the dollar markets and the European markets as well, right? But do you see a lot of people looking to diversify their funding access or, away from dollars maybe?
So certainly we're seeing that with many of the larger issuers. The hyperscalers have often been
Right.
talked about as accessing liquidity across the core currencies, as well as perhaps some of the smaller markets. This week, of course, we saw a high level of activity in the Canadian dollar market, and needless to say, one of the busiest days ever in the euro market. So I think borrowers, despite the fact that dollars is continuing to see its busiest start to the year ever,
Right.
borrowers are proactively evaluating different opportunities across various currencies. And I think that diversification theme will continue so long as funding levels are competitive in different markets. And it won't always, for example, need to be a clear arbitrage to motivate a borrower to select, as an
Right.
example, euros over dollars. Clearly that can help be a driver.
Right.
But I think as we're seeing the growth of the dollar market and as we're seeing the growth of a number of other currencies, that move to diversify and consideration across different regions will certainly remain an important theme.
Right. Is there any examples of borrowers you've taken in different currencies recently or, this year?
So we've one notable market that I think has often come up in conversations with issuers is the Australian dollar market.
Right.
And obviously, it depends on the borrower and depends on the part of the curve. But in many instances, that market has offered arbitrage opportunities for dollar-based funders. And so the level of activity that we're seeing there and the number of conversations we're having with issuers about that market is certainly at a different level than it was 3 or 4 years ago. And so that's an instance whereby I think you're clearly seeing this diversification push and theme play out real time. And those investors have demonstrated very strong interest for non-domestic issuers to visit their market. And I think with very few exceptions, the success of those transactions is a motivator for other borrowers to similarly consider those liquidity opportunities.
Right. They're called kangaroos, right?
Kangaroos, exactly. Interesting and often creative names for those types of deals.
Right. Right. And I also wanted to ask you about reverse Yankees, right? Because this is such a hot theme this week. On Wednesday, we have 31 deals in the European market, but I think on Tuesday we had a lot of big reverse Yankee issuance. Alphabet was there, Booking, the travel company was there. What is driving this? So we saw this is like a record year for reverse Yankees. So can you tell me this is the same thing? Is it diversification or is it arbitrage? What's driving it?
So it's an important theme, and we've been talking about it at length with many of our U.S. borrowers.
Right.
Just as a reference, and I think the statistic is interesting. In 2025, reverse Yankee issuers represented for the first time the largest single percent of issuance in the euro market relative to other countries. So as an example, Reverse Yankee was larger than UK issuers or than French issuers or than Italian issuers. So clearly that speaks to the popularity of this funding opportunity among non-European issuers. And to your point, we're seeing that level of activity continue to play out this year. I think part of it, as you alluded to, is certainly price driven. For much of last year, and often is the case this year, depending on the borrower, it does present more attractive issuance pricing than the dollar market. But also the diversification push is a critical driver as well. And I think that's true certainly for the hyperscaler borrowers that are looking to efficiently source liquidity, not just in the dollar market, but also markets that ultimately will drive the most attractive pricing in aggregate across currencies. So I think that dynamic is going to continue to play out over the course of this year, barring any major movement in, for example, the cross-currency basis.
And hyperscalers, they are looking at all kinds of markets, I guess. What is your chats with them reveal?
They are. So I think, needless to say, everyone has seen the headlines around the CapEx and the consideration to fund a lot of that CapEx in the investment grade markets. And I think given the profile of these borrowers, there clearly is name recognition across the global investing space. And so the conversations are such that what markets offer the best opportunity at any given time, and how should they think proactively around what their funding outlook and profile looks like in a 12-month period. And as such, a lot of the call it non-dollar opportunities are very topical. And this week, as you mentioned, we're seeing a tremendous amount of activity, and I think the success of each deal reflects the opportunity for further issuance, and is motivating not only those hyperscalers, but also call it more regular way or smaller companies for considering those markets as well.
Hey, Jonathan, is there a concern? There's some chatter in the amongst macro guys about concentration risk. It was the thing in equities, as the Mag 7 companies make up an increasingly large percentage of the index. Is that becoming an issue with corporate bond indices as well, as those same companies flood the market with issuance? I guess the concern is that there's so much issuance from a lot of the same names in the same business that it becomes the corporate bond market becomes more sensitive to equity prices than it may have in the past.
The markets over the course of the different crises and periods of elevated volatility, I think have shown a tremendous ability to efficiently price risk. And to your point, while we are seeing larger issuance activity from specific names, at least as we think about the order book participation or the level of secondary activity, there doesn't appear to be any resistance or defensive behavior from investors evidencing concern around that. And while there's obviously always the possibility for change, at least in the context of the conversations I've had, or as said, for example, Meta's recent transaction had an order book of nearly 100 billion. We're just not seeing it in the data. A year from now, it's always possible that there's a different dynamic, but at the moment, we're just not seeing it.
Yeah, look, I mean, I have to admit, it's coming from a lot of the same guy. When you said that the markets are efficiently pricing the risk, these same guys are saying they're not pricing the risk properly. Right.
Sure,
but
sure.
It's the same guys that were with their hair on fire during the tariffs and everything else.
And, that's obviously it's what makes a market, right?
Yes, exactly.
You've got informed, intelligent views on both ends of the risk spectrum.
Yeah.
Right. And Jonathan, can I also ask you about M&A funding? Because SMBC is so active in the M&A market. It has started really strong this year, right? The M&A funding volumes. Is there an outlook on how this is going to keep going?
I mean, we're at a record pace for investment grade, with approximately 100 billion having priced year to date. And I think 10 years ago that would have been just an extraordinary number. But given the
Right.
level of activity that we're seeing across a number of different sectors, such as the hyperscaler space, it perhaps doesn't get quite as much headline focus as it otherwise would. But to your
Right.
point, the level of activity is exceptional, and the level of support that the debt markets have shown for these M&A financings is also very encouraging, and in many instances, extremely attractive funding opportunities for these borrowers.
Right.
I think, speaking to the outlook, we're going to continue to see the investment grade market in particular an often used source of liquidity to finance these M&A transactions. With very few exceptions, the deals have been well received. They've been oversubscribed to significant multiples. And again, I think given the risk backdrop, companies have, for I think in the vast majority of cases, been rewarded for taking more strategic approaches to their business. And as said, the liquidity, I believe, will remain. Whether or not we continue at a record pace throughout the balance of the year is of course difficult to say, but without
Right.
a doubt, it will end up being certainly one of the more active years that we've had.
So you think a 2 trillion number on the high grade volumes, is that possible, or you think it will be where do you see it?
I think so. Our estimates going into the end of last year, based on the outlook, based on conversations and the redemption profile, was that 2 trillion number.
Right.
We've already had north of 850 billion price year to date. So on a month adjusted basis, we're actually trending ahead of 2 trillion.
Oh
Of
my
course,
God.
seasonally there are months that are less active, and I think we've had as said, a record-breaking start to the year. But I do think, to your point, Shanks, 2 trillion, at least based on what we're seeing now, feels like an achievable number. And to be honest, it wouldn't surprise me if we're in excess of that as of December 31st this year.
And like this is the other question I always wanted to ask is, do you see another Verizon deal coming this year? Do you think there would be a $49 billion deal in the dollar markets or more?
I don't know that we'll see another, call it 49 or 50 billion jumbo
Right.
financing. I think it's certainly achievable if one of these larger borrowers were looking to price one.
Right.
But just given the financing needs and given the expectation, I don't know that we'll see one. But look, we certainly could. And as said, the market has shown a remarkable ability to I think, invest in and trade well
Right.
25 to the plus billion size financings. So while it wouldn't surprise me, I'm not aware of one at the moment, let's say.
And like there's one more topical issue which everyone talks about, and I think I've seen a lot of news about it recently as well. It's about the private credit space, right? There is constant. We had guests before who said, we haven't seen defaults rise, so we don't know if there is, but visible and not visible. That's the problem with private credit because there's not a whole lot of transparency to it. But what is your take on it? Like, do you think that sector, because as a bank, you deal with a lot of private credit clients to help with their borrowing. What do you make of this whole perception about cracks in private credit?
As you said, it's clearly getting more focus over the past several months than it was previously. Call it, with many of these headlines framing it in a more concerning context.
Right.
We're active in that space vis-a-vis BDC issuance. But just as an anecdote, the three most recent BDC deals that we were an active book runner on, those saw the largest order books that we've ever
Right.
seen in the sector, and we've been extremely active as an underwriter of BDCs. And so, peak order books at a time where headlines are painting concerning narratives, clearly there's one of them is wrong, so to
Right.
speak. And I think, generally speaking, while you have seen some large retail capital outflows in certain funds, overall, we continue to see very strong fixed income investor support
Right.
for the sector. And of course, BDCs are not the only element of private credit, but it is, at least for the investment grade space, a liquid investing opportunity, and certainly a liquid space to express a view. And while there were periods of significant widening at the height of perhaps the negative headlines,
Right.
as mentioned, the three most recent deals that we were leading, they saw
Right.
the strongest level of subscription that we've ever
Right.
seen. So clearly there are different views on the space, but overall, as to the level of investor support and dialogue that we're having,
Right.
I'm encouraged by the current situation and by the outlook.
There's not a whole lot of negatives to talk about.
I
Uh,
mean, yeah, the reality is, look, as we've been talking about throughout this session, the market backdrop is very strong,
right.
but inevitably there will be some catalyst for repositioning of risk. The trick is knowing what it'll be and when it'll come. And
Right.
there have been varying degrees of success around that positioning, of course. But
Right.
as said, there aren't a whole lot. The negative headlines, so to speak, right now don't seem to be driving systemic risk off tone or
Right.
behavior from the buy side.
Right. Do you see, are there any red flags in your world that you
You
keep
should
you up
watch
at
for,
night,
yeah.
or that you see out there?
There aren't any red flags per se, but often during conversations with issuers or with investors, the topic inevitably comes up. What are what are possible concerns? What could change the dynamic that we're seeing right now? And candidly, it's difficult to find one that everyone agrees on. And I think that's partly the reality of why we're seeing such a strong market backdrop. I think over the next, 6 to 7 months, as we think about how the balance of the year will play out, one of the topics that is often referenced is inflation, and do the higher energy prices that we've seen post the conflict in the Middle East, does that negatively impact inflation more than folks are thinking? And as a result, do we see a shift in policy from the major central banks? Could that be a catalyst for slightly more defensive positioning from the buy side? I think it's certainly possible, but at the moment, we're just not seeing that dynamic play out. So
Right.
it
Right.
feels less like a red flag and more like a theme that folks are observing, but not at the moment positioning for necessarily.
And Jonathan, I also wanted to talk to you about your experience in Syndicate. And you've been there for a long time. What do you think? How has that process changed? Like what I've noticed is things are getting done faster, right? Like yesterday or on Tuesday, I noticed there were like deals which were like priced before 3 o'clock, which is kind of how fast can it get? So is that what you're observing? Like how things getting faster, more efficient, or is it like you're just too good at this now?
Efficiency is without a doubt a
Yeah.
theme that we've seen play out time and time again in the market, and I think in many ways, when the vast majority of the industry was working from home during COVID, that was a real test
Right.
to the execution process, the efficiencies of the market, and in a circumstance, as said, where everyone was remote. And
Right.
needless to say, it was the busiest time ever for the market. And while we might break that record this year, at the moment, the record still stands.
Right.
And I think some of the themes or practices that have evolved since that time are, to your point, a more expeditious process for getting deals priced. We've seen in almost all instances now, guidance for most deals be the number as opposed
Right.
to area or a range.
Oh,
And that's clearly different than the way it was 10 years ago. The number was the exception as opposed to the norm.
yeah.
But I think generally speaking, both the primary and the investing side has embraced the notion of a more efficient process benefits both parties. And clearly, we've had multiple examples of more than 15, or in many instances, 20 different deals being executed same day, with the buy side able to evaluate participation in a seamless fashion across a multitude of financing. So, long-winded way of saying, without a doubt, the process has become more efficient. I think those
Right.
opportunities for efficiency will continue, and deals are in many cases being priced earlier and earlier.
What did your day look like during COVID? I mean, I was a trader, so
Right.
it was always nice to sit on a desk, but you didn't have to. But with in your line of work, there's a lot of moving parts. I mean, was it just an endless series of Zoom calls all day, or how did that work during COVID?
It was a lot of calls. It was a lot of, I would say, simultaneous calls. You might be listening to one call, or listening to two at the same time. Everyone, I think, was looking for information, and because the entire street and arguably industry were remote, it felt even more important to try and stay real time on all the developments as they were happening. And it was a tremendous opportunity, even though everyone was remote, I think, to lean into relationships, because issuers and investors both were looking for information. And
Right.
Syndicate is positioned uniquely in that you have that level of connectivity, and you're able to, I think, be kind of the driver of how that information is shared. So my circumstances where I was in front of screens, much like I am now, but most of the day, and on calls constantly, trying to understand what the themes were, where the opportunities were, and advise borrowers how to position themselves as best as possible to take advantage of it.
I imagine it was a real opportunity to build trust with certain clients that probably has served you, to this day.
Most certainly. I mean, as a crisis is a time where I think you really can deepen trust, because obviously everyone is looking for answers, and everyone is looking to be positioned as smartly and as nimbly as they can be it either an issuer or an investor. And I think staying close to folks and building that trust ultimately pays tremendous dividends in
Mm.
the future. And as you said, COVID was one such example of that.
So that is a good segue into the next question, which is what is your advice to all these young graduates who come up and want to be the next Jonathan Anderson?
I think the industry is an very exciting one to work
Right.
in, and the developments in the marketplace, the headlines, the volatility has made it continue to be an extremely exciting one to work in. And I think the talent that we're seeing at our firm, as well as across the street, is exceptional. We haven't seen any any ebb, so to speak, in the level of interest or the quality of graduates that we're interviewing. And so
Right.
I think it speaks to a very exciting entry point, so to speak,
Right.
in the industry, and specifically within capital markets.
And do you
Did,
think
did,
AI will have a disrupt this? Like, given this move towards efficiency, do you think AI will just take away the need to not have too many heads on the desk?
I actually think AI will serve to enhance and augment the
Right.
output that juniors are having. In many instances, it frees them up to work on more interesting or more strategic opportunities.
Right.
And so ultimately, I think it will serve the business needs well. And I don't I don't necessarily see it eliminating or reducing headcount. I think it ultimately can make analysts and juniors more impactful as to the quality as well as quantum of work that they're able to support.
And okay, so that's all we have time for, and we exceeded it a bit. I think I talked too much, but
No, not at all, Shanks. You keep the conversation going. So
so thank you very much for that, Jonathan. And
Yeah, thanks, Jonathan. Appreciate it.
and you know, I have to say this because yesterday we were having a chat, and I think Bruce mentioned something about joining the party but staying dancing near the door. Is that an old phrase?
Oh, well, you know, it's an expression when markets get pretty frothy, and
Right. Well,
you
it
know,
doesn't look
it-
like it. It doesn't look like it. Everyone is dancing in the middle
yeah,
of
it's
the
just
party.
it's just a cautionary slogan. Enjoy the party, but dance near the door is how is the
It's not
expression.
happening now.
Yeah.
hope for the best, prepare for the worst. It's a good mentality to have, I think. But as said, things feel great right now, and hopefully it continues for quite a while.
Right. They're all doing the Bhangra right in the center of the dance floor. But thank you very much for that, Jonathan. And thank you all for listening to us. Subscribe to Credit Matters on YouTube, Spotify, Apple, or wherever you get your podcasts. And tune in next week when we get another great guest and we dig into the latest credit events. If you want to receive real-time reports, market data, you can request a free trial of IGM services. Do it! The link is in the show notes. Thank you again and have a nice weekend. And thank you very much, Jonathan. Thanks a lot for coming. Thank you.
Thank
you.
you.